So those of you that have been watching for any amount of time know I really like Aesop's Fables. And you also know I'm really a fan of this daily wealth site. It's free. It's about 5 minutes to read each article, and they put out about 6 per week. I don't have any relationship to them, it's just good information. And by the way, don't buy any of their newsletters, or none of it is worth it. Just read this quick 5-minute article every day if you're interested in learning more about money. It's like getting good at anything. Like, you want to get good in you want to be in shape. It's not the guy that puts in 2 hours at the gym today that's going to be in shape. It's the guy that puts in 30 minutes to 45 minutes today and tomorrow and the next day and the next day. It's that consistency that gets you where you want to be. And it's the same with learning about something like investing your money. I've been studying the market for 17, 18 years now. And so over time, I learned, that's what got me actually interested in politics, is because I was learning about money, and then you learn how politics is tied into money. And then you see the real darkness out there in the world. But this is a good one. I want to highlight this and look at a few things, some recommendations for how to handle your money going into a fall that is potentially dark. I don't know. And I've talked about compounding, how you earn money off of money, and how you can really make your money work for you, because we don't have pensions as a millennial group. I mean, I have a small one that's been cut off, but we don't have pensions the way older generations got. So you have to learn how to make your money go further. So let's just run through this article quick by Dan Ferris called Investing Lessons from the Hedgehog and the Fox. He says, I come back to timeless pieces of advice every now and then, and you know I'm all about timeless wisdom. It's the only wisdom is timeless. Otherwise, it's not wisdom. So he says, whether you believe you discovered a system that will work for you or have been struggling to improve, the rewards you seek as an investor require greater self-knowledge. Oh, internal. You got to know thyself. It starts with a simple question that has profound implications. Are you a hedgehog or a fox? If the question rings a bell, maybe you're familiar with the 1953 essay by philosopher Sir Isaiah Berlin, The Hedgehog and the Fox. The topic is introduced in the opening line. There is a line among the fragments of the Greek poet Aristophanes, which says, the fox knows many things, but the hedgehog knows one big thing. Berlin starts by explaining the figurative difference between hedgehogs and foxes. According to the essay, hedgehogs relate everything to a single central vision, one system, less or more coherent or articulate, in terms of which they understand, think, and feel, a single, universal organizing principle. Meanwhile, a fox pursues many ends, often unrelated, even contradictory, connected, if at all, only in some de facto way, without consciously or unconsciously seeking to fit them into or exclude them from any one unchanging, all-embracing, sometimes self-contradictory, and incomplete at times fanatical unitary inner vision. Well, clearly by that description you want to be a hedgehog. It's kind of like the difference between a conservative and a liberal. Some ridiculous nonsense that all is self-contradictory versus a centralized vision. And I've done this with the political garden. The right is more like the taproot, and the left is more like the fibrous root system, broad and shallow versus deep. So he wants to use this. The idea of determining if you're guided by one big thing versus many things is a valuable way to gauge your own investing style. Do you invest in one big thing like the hedgehog or in many things like the fox? And that's because knowledge, there's so much out there. It's why you can go really, really deep into one idea and you will become much more competent and much more valuable rather than trying to scatter your fire. He says most successful investors are hedgehogs. Hedgehog investors come up with their own system, their own one big thing, and they eliminate everything that doesn't conform to it. And you can read the rest of the article. That's about all I want to cover there. But I was thinking, well, what am I, right? Am I a fox or am I a hedgehog? And you got to be honest in your self-assessment here. But I was thinking, really, I do have a hedgehog tendency. And that is what I've talked about, dividend aristocrats, earning interest and then earning interest off of your interest. It's called compound interest. Einstein described it as the most powerful force in the universe, but it's basically making your money work for you. Say you have $100 in the bank, they pay you 8%, so you now have 108, and then you reinvest that $8, now you're earning 8% on $108. Rinse and repeat, and over enough time, you end up making money off of your money, and it compounds, and it gets really out of control. It gets really large. The biggest and most difficult part of the formula is time. So I realized my unifying principle is dividend aristocrats. And you can see there's these 65 stocks, and what does a dividend aristocrat mean? You can just Google it. But there's 65 companies who haven't just paid dividends for 25 years, at least 25 years. They've also raised their dividends for a minimum of 25 years. So imagine you're earning 8% at your bank on your money, but on top of that, and reinvesting that 8%, they also raise it from 8%, and the next year it goes to 9%. 9%, the next year it goes to 10%. 10%, you get it, right? Like, that is how these companies work. Now, I wish your bank would do this, but you got to assume some level of risk in order to get this level of reward. And it's one of the things that I've been focusing on now for the 17, 18 years I've been studying markets. And so you can just see a list of these companies. 3M, 63 years of dividend growth, currently pays 2.9%. For 63 years, they've raised that dividend. Now, the second they fail, the second they stop, I'd get out. But what I've been working on doing is building a list of these companies that you buy up at a cheap price, because as the price of a stock goes down, like if the market crashes and 3M goes down by 50%, this will go up to almost 5% or more. The dividend goes up as the price goes down. So if you buy during panics, you can lock in a higher interest rate, which then will get raised every single year, and you can see how that compounds your wealth even faster. So you're not doing just compound interest, you're also buying a company that raises its dividend, and you're not just buying that, you're also buying it when the market is under duress, so you're locking in a much higher interest rate. Nobody stops you from doing this. Nobody stops you. And every 5, 10, 15 years, something like that, the billionaires open the gates to their safes, unlock their safes, and they give all of their money away. Not all of it, but they give a lot of money away. Let me say that again. Every 5, 10, 15 years, billionaires unlock their safes and they give money away. They give money away to me and they give it away to you. And I've been pretty blue collar my whole life, never had big money. Well, how do you know this? How's the indicator? Well, I've lived through the market crash of 2000. I've lived through the market crash of 2008 and the market crash of 2020. And one of the things I learned, like going into this fall, I've tightened up my trailing stops to 20%. Usually I keep them 25, sometimes even 30. Right now, the companies that I am not going to hold for life, I have 20% trailing stop, which means if they go down 20%, I sell. I'm out. So I will never lose huge amounts of my money because I can't. There's a stop in place. I will get out and I will be fine while the market crashes. And that's where you see the sales. That's where you see the billionaires giving away their money for very, very cheap. You just have to understand when they're doing it. So this is called the VIX, V-I-X. You can look it up in Google Finance. You can look it up in Yahoo Finance, V-I-X. It's called the fear gauge. Right now we're at 15. 15 is low. And this is the past 5 years. You can see 11, 12, 15. Like, this is market complacency. This is where the market generally stays. And then you can see, right here, 30. And 30 is kind of the magic number. You get over 30, you're probably looking at a correction, big, small. You'd have to marry it up to the greater market, but 30 is where things get interesting. And you can see that was in 2018, There was some fear, and then it goes back down. 12, 13. Okay, the billionaires aren't scared. The billionaires aren't giving money to me and you right now. And then, here we go, over 30 at the end of 18. There was somewhat of a correction, okay. And then it goes back down. Okay, they're not giving their money away. And now we hit this point here when the cold 19 broke out. 66. Now, I actually think it went over 80 for a day or two, which is insane, but it was so fast. This graph doesn't even catch it. But over 50, over 60, over 70, this is when billionaires are saying, here, take my money for free. And I learned this during the crash of 2008. I bought a copper and gold mining company called Freeport-McMoRan, ticker was FCX. And I said, I will buy it for $40. So I walked up and offered a guy, say there's a $40 bill. Hey man, here's $40. And he said, here you go. And they sold me the stock for 36. That's what happens when you get the VIX way the heck up here in the 50s and 60s. When the billionaires panic, you get hedge funds have to sell, other hedge funds have to sell. They get redemptions. They say, give me my money back at any price. They lock in these enormous losses, and the price of these assets craters spectacularly, and you, the little guy, can step up and get them for vastly less than they are worth. And just like the aristocrats, as the price crashes, these yields go up. This Abive, if it goes down by 50%, that yield is almost 9%. And they've raised their dividend for 50 years. So when your VIX is out of control, now you got to have a strong stomach because the market does wild things. It's like zero gravity. It's like a riot. It's like all the rules get turned off when the fear gets this high. But you should watch this VIX every day because it may take 10 years. It may take 15, but it does happen. And the billionaires puke their stocks. And then you can look at your aristocrats, and I just do this. I build up these dividend payers. Coca-Cola raised their dividend for almost 60 years, 3.1%. If the greater market crashes, that will be a 6% yield that gets raised every single year. And let me show you how, because I did this with Lowe's during the last crash. It was trading at $120 a share, okay? And then when we hit here, Lowe's went from $120 to $60 a share. So that yield went from like 1.5% to 3%. So I locked in a 3% yield. Okay, they've raised this dividend for 47 years. Now, I didn't have this much money, but let's say I did. Let's say I had $30,000 I put in and I locked in a 3% yield. So I had $30,000. I would be earning $1,000 a year in dividend income. Okay? Well, Lowe's raises this dividend every year for almost 50 years, and it raises it by a lot. They just raised their dividend by 33%. So if you were earning $1,000 a year in interest because you bought it back when the VIX was really high and everybody panicked, you are now earning $1,300. These are loose general numbers, but you get the idea. After 1 year, your interest goes from $1,000 to $1,300. But they don't stop after 1 year. They do it every single year. So if you establish a position during a panic, okay, which is easy to spot because the VIX goes to the moon, the billionaires puke their stocks. They give them to you almost for free, assuming you have enough capital to scoop it up, right? This is why you need savings and not debt. You now lock in a 3% interest rate instead of the piddly 1.1 it's paying right now. And then for the rest of your life, they will raise that dividend by these huge amounts. And you can see 1 year, 1,300. But what about after 10 years? What about after 15? I've been at this for 17, right? 17, 18 years, something like that. I have companies that pay me some pretty serious cash. As I'm 40, I now can tell people my bills get paid by the stock market. Now, I don't do that. I reinvest the dividends, but the money I make from the stock market pays my bills. It buys my groceries. Okay, I am building a pension for myself. And this is how I do it. This is me as a hedgehog, right? Like, how am I a hedgehog? Well, because I have this one idea. I watch the dividend aristocrats. I wait for the market to crash. When the VIX gets real high, I have a very high tolerance for short-term losses because I understand what I'm doing, because I spend my 5 to 10 minutes a day every day researching, and I buy these companies that raise their dividends substantially, and then I reinvest the dividend, so the money is earning money. I buy the company under duress under the first place, so I get a higher dividend than you ordinarily would, and then I only buy companies that raise their dividends every single year for half a decade or more. And so that 1,000 becomes 1,300. The next year, that 1,300 becomes 1,700. After 3 years, you're making over $2,000 a year. You get to 5 years, you're making almost $3,000 a year. You get to 10 years, all of a sudden you're getting almost $1,000 a month. And that's how you do this. This is what you got to do. And it can't just be, can't someone else do it? I'll just give somebody else my money and put it in one of those funds that manages it for you. Well, you get what you pay for, and you get what you put in. Like, this isn't that complicated. Just start reading these damn daily wealths every day. Start learning. Start getting educated. Start watching. Turn off the television. This information is out here, and it's free. You just got to be willing to put in the time. And think about it. Come up with your hedgehog plan. And you don't have to copy mine. This is just what I'm doing. Like I said, I'm tightening up my stops. There's a lot of stuff you pick up during a bull market that I'm got profit in that I'm ready to sell if the market swoons to raise cash because I'm waiting for the next huge VIX spike. And it's beautiful. Like, you can see, look at 08. Man, look at the fear. I can't even get on that peak. But these were some beautiful prices. The billionaires were panicking so hard, they were willing to sell you companies for less than you were willing to pay. Here, man, here's $100. I'll sell it to you for 85, but I'm giving you 100. I'll sell it to you for 85. Like, that's how desperate they get. So I don't know. I hope you found this useful. This is my plan. I don't give financial advice on specific stocks. None of these are recommendations. They're just observations, all the legal mumbo-jumbo. Do your own research. Do your own thinking. This is real out in the open, plain sight stuff. Get out of debt. Start making your money make you money, even small amounts. My first dividend aristocrat was paying me $10 a month or $30 a quarter. And now it's like $500 or $600 a quarter. 18 years later, takes a lot of time, but if you're 20-something, trust me, you're just going to wake up one day and you will be 40 years old.